Cryptocurrency has taken the financial world by storm over the past decade, evolving from a niche interest into a mainstream asset class. Bitcoin, Ethereum, and hundreds of other cryptocurrencies are now recognized by investors, institutions, and even governments. Despite its growing popularity, cryptocurrency investing is not without risks. In this video, we'll explore the rewards and risks of investing in cryptocurrencies, giving you a balanced view of this dynamic market. Whether you're an experienced investor or someone considering entering the world of digital assets for the first time, this guide will provide valuable insights to help you make informed decisions. What is cryptocurrency? Cryptocurrency is a digital or virtual currency that uses cryptography for security. Unlike traditional currencies, which are controlled by central banks, cryptocurrencies operate on decentralized networks based on blockchain technology. Blockchain is a distributed ledger that records transactions across a network of computers in a secure, transparent, and immutable way. The most well-known cryptocurrency is Bitcoin, but there are thousands of others, including Ethereum, Litecoin, and Ripple. The appeal of cryptocurrency lies in its potential for high returns, decentralization, and innovation. However, with great potential comes significant risk. The rewards of cryptocurrency investing. 1. High potential for returns. One of the biggest attractions of cryptocurrency investing is the possibility of high returns. In its early days, Bitcoin was worth just a few cents. Fast forward to today, and its value has skyrocketed to tens of thousands of dollars. Early adopters of cryptocurrencies like Ethereum and Binance Coin have also seen their investments grow exponentially. While past performance doesn't guarantee future returns, the rapid growth of many cryptocurrencies has made it possible for investors to earn significant profits. In particular, investors who participate early in promising new projects can see substantial gains. 2. Diversification of investment portfolio. Cryptocurrencies provide an opportunity for diversification. Adding crypto to your investment portfolio can reduce risk, as these assets often move independently of traditional markets like stocks and bonds. For example, when traditional markets are down, cryptocurrencies might perform better, offering a hedge against market volatility. That said, it's important to note that cryptocurrencies themselves can be highly volatile, so while they may offer diversification, they also bring unique risks. 3. Liquidity. Many cryptocurrencies are traded on global exchanges 24/7, making them one of the most liquid assets available. This high liquidity allows investors to enter and exit positions easily, compared to traditional markets that may have limited trading hours. The ability to quickly convert cryptocurrencies into cash or other assets adds to their appeal. 4. Technological innovation and the blockchain. Investing in cryptocurrencies is not just about the digital assets themselves, but also about the underlying blockchain technology. Blockchain has the potential to revolutionize various industries, including finance, supply chain management, healthcare, and more. By investing in cryptocurrencies, you are indirectly investing in these innovations, which could lead to broader adoption and further financial gains. 5. Decentralization and transparency. One of the core principles of cryptocurrencies is decentralization. Unlike fiat currencies, which are controlled by governments and central banks, cryptocurrencies operate on decentralized networks. This decentralized nature removes intermediaries, such as banks, and provides greater transparency and security. Many investors are drawn to the transparency of blockchain, where all transactions are recorded and verifiable, promoting trust within the network. The risks of cryptocurrency investing. 1. Volatility. While the potential for high returns is a key attraction, cryptocurrencies are notoriously volatile. Price swings of 20% or more in a single day are not uncommon. This volatility can lead to significant losses for investors, especially those who enter the market during a price surge, only to see the value of their assets plummet shortly after. For example, Bitcoin reached an all-time high of nearly $65,000 in April 2021, only to lose more than half its value by July of the same year. Such dramatic price movements can be difficult for investors to stomach, making it essential to have a long-term perspective and a clear strategy before investing. 2. Regulatory risks. Cryptocurrency is a relatively new and evolving market, and governments around the world are still figuring out how to regulate it. While some countries, like the United States and Canada, have embraced cryptocurrencies, others have banned or heavily restricted their use. Regulatory uncertainty can impact the price of cryptocurrencies and the ability to use or trade them. For example, when China cracked down on cryptocurrency trading and mining in 2021, the price of Bitcoin and other cryptocurrencies dropped significantly. Regulatory changes in the future could further impact the market and lead to price declines or reduced adoption. 3. Security concerns. Despite the security offered by blockchain technology, cryptocurrency investors face unique security risks. Hacking, phishing attacks, and other forms of cybercrime are prevalent in the cryptocurrency space. If an investor's private key or exchange account is compromised, their assets can be stolen, and unlike traditional banking, there is no recourse for recovering lost funds. Moreover, some cryptocurrency exchanges have been hacked, resulting in the loss of millions of dollars in assets. It's essential for investors to use reputable exchanges, enable two-factor authentication, and store their assets in secure wallets to mitigate security risks. 4. Lack of consumer protections. Unlike traditional financial institutions, cryptocurrencies are not insured by any government agency or financial institution. If a cryptocurrency exchange goes bankrupt, is hacked, or is otherwise compromised, investors may lose their entire investment. Additionally, because transactions on the blockchain are irreversible, there is no way to recover funds sent to the wrong address or lost due to a scam. Investors need to be diligent and cautious when dealing with cryptocurrencies and should be aware of the lack of consumer protections in the space. 5. Market manipulation. The cryptocurrency market is less regulated than traditional financial markets, making it susceptible to manipulation. Pump and dump schemes, where a group of investors artificially inflate the price of a cryptocurrency before selling off their holdings, leaving other investors with significant losses, are more common in the cryptocurrency space. Furthermore, large holders of a particular cryptocurrency, known as whales, can influence market prices by buying or selling significant amounts of assets. Such manipulation can lead to unpredictable price movements and increased risk for smaller investors. Cryptocurrency investing offers both exciting opportunities and significant risks. For those willing to navigate the volatility and uncertainties of this new market, there is potential for high returns and diversification. However, it's crucial to remain cautious, do thorough research, and only invest what you can afford to lose. As with any investment, the key to success in cryptocurrency